Okay. What's going on, everybody? My name is Ben Julius, and I am the host of FundFocus, where we look at emerging fund managers and what they're doing in the finance world and the capital markets. Today, we have Stuart Heath. Really excited about this from Harvard Grace. We're going to get right into it. Stuart's in the real estate space. So commercial real estate's been hit hard by rising rates, office disruption, and capital tightening. Yet, you and your company are preaching stability, and boring is beautiful. All right. Some would just say boring is low returns. Let's unpack that, man. Stuart, what do you got for us?
Well, thanks for having me first, Ben. I really appreciate the opportunity. Boring is not code for low returns. I will say that they are lower returns expected as compared to your average development deal or something like that, which has much higher risk. And those are the same guys who really got slammed with the rising rates, because nobody would have underwritten a 5.5 point increase of interest rates in less than a year. Nobody did underwrite it. Nobody would have, and it was unreasonable to think so. But if you consider returns in the low 20%, very stable, day in, day out, quarter in, low returns, then okay, I'll own low. I'll be low all day long.
Sure. But most people would, right, with that.
We think that's very favorable. Across our portfolio, we're averaging cash on cash returns into the 12% range. And that's an average. We got some that are doing 6.5. Those are newer ones. And our oldest one is throwing off 16%. And that's just the cash on cash. That doesn't take into account the tax benefits. Mm-hmm. It doesn't take into account the anticipated capital gain when we get back, and it doesn't take into account the cash we've sent back to the investors from a refinance that comes back to them on a tax-free basis. So again, if that's low returns,
boring is beautiful. If that's what we're talking about, right? So okay, so let's go through this a little bit. So we talk about how you're hitting your numbers, you're hitting your returns. That's all fine and good, but how are you hitting these returns in this type of volatile market that we have right now, where certain things are up, certain things are down? We're seeing asymmetrical risk over here, and we're seeing major opportunities to pick up distressed properties and distressed portfolios. So how do you and your company, Harvard Grace, your fund, operate on a day-to-day to take advantage of some of these things?
Well, in short, we operate the same way we did before COVID as we do now. It's just a disciplined approach. We have a set of rules. I put them in a book. And rule number one, these are not original to me. So, but rule number one is you make your money on the buy, not the sell.
Totally.
If you buy it right,
you're making money.
For one, you've got some room to have some mistakes made, because nothing ever goes exactly according to plan. But if you buy it right, you've got a great opportunity for some success. And we define our buy box, and we start with our minimum cash on cash return, because all we're doing is buying stabilized properties.
So I'm just going to hold you for a second there, really quick. And we talk about this a lot, is the buy box. Your buy box is one of the most important things that you have in a fund. It gives your LPs. When we talk about LPs, we see our limited partners, our investors, the security, the trust that you're going to be able to do this. You're going to stick within that buy box. So when you hear the word buy box, that means that you got somebody here who knows kind of a thing or two of what they're doing. Maybe they've gone through some experience and they've kind of narrowed their buy box. So I'm really excited, Stuart. So I had to stop you. I wanted to explain buy box for a second. I really want to hear what your buy box is that's giving you these returns. So it's really important that we get through your buy box. So go on here. Break it down for us.
Our buy box, or other people might say, what is our investment thesis?
Yeah.
I don't have a PhD, so I don't want to pretend like I have one. So, so my buy box is we start at the bottom. For starters, we do not focus on an asset class. We do focus on a region. We buy from Nashville to Birmingham, sort of the I-65 corridor.
Yeah.
And I've lived here my whole life. All of my partners and my employees, we've lived here our whole life, and we do property management. So we have to be able to get to our property within an hour and a half in case.
Love it.
So, but what we're willing to buy is anything that from purchase will throw off minimum year one cash on cash of 5%.
Okay.
We haven't bought a minimum one yet, so I think the lowest one we did was 6.25 year one, and then we expect to see that to go up into double digits cash on cash in the first 3 years, and you do that by it's always a multi-tenant deal. I won't do single tenant, just because there's greater risk there.
Oh yeah.
I mean, because when you're buying real estate the way we do, we're basically bankers, if you would. We are extending credit to these tenants. We underwrite those leases just like a banker or any credit underwriter would do. We pass on a lot of properties that have a really bad tenant mix in them. Might be a great location, might be a first-class building, but if the tenants aren't right, I mean, that's your income. So
Right.
we're buying financial paper and getting real estate as a bonus. It's almost
Sure.
like buying furniture when you're newlywed. So borrow money at 18% and get some furniture for free. So
Right.
And of course the real estate provides all the tax benefits. So we look at all of that, underwrite every single piece of it, and when you buy it for the right price, then the income falls out, and we start paying out distributions to our investors day one.
Let me ask you a question.
Yeah.
When you guys are buying these properties, have you ever been embarrassed by your first offer because it's so low?
I have I originally heard that from Carlton Sheets years and years and years ago. And I totally, my real estate brokers hate it.
Yes.
But yes, if the rule is if you're not embarrassed by your first offer, then you're offering too much.
Exactly.
And half the time they come back very surprisingly. Sometimes you get a door slammed in your face, and that's okay.
That's right. You got to kiss the box every once in a while, right? Before you find the prince or the princess, however you want to look at it. But yeah.
That's right. Well, you can always knock again and make another offer. But
I always tell people that you can always go up. It's really hard to go down.
It's impossible to go down.
Yeah.
Unless you find something horribly wrong with the property, and then you probably don't. You probably want to walk away. But yes, make a ridiculous offer, because you don't really know what's in the seller's head.
No, and you don't know, we talk sometimes about the D's of real estate, right? Death, divorce, and disaster. So you have no idea what stage a seller's at or where they're at in their life or their process or whatever. So, somebody once told me that, you're taking advantage of that. I'm like, no, I mean, that's life. Everybody goes through something. You're going through stuff. I'm going through stuff. Everybody's got their own things that we're going through. So you have to be prepared to take advantage of it. And it sounds like Harvard Grace is positioning itself to take advantage of dips in the market and buying at the right time and holding and selling. So let's go through a deal cycle. Like where are you maximizing? How are you looking at different things? And just talk about your process from, obviously, we've talked about how important the buy is and making money, but let's talk about some operations. You mentioned that you guys are vertically integrated, so you only purchase along your corridor, which I love. I've gotten rid of properties that were just a tad too far for me to drive to, and I was just like, I don't want to deal with this.
Yeah.
Right? It's just too much of a headache.
You can't do it well, so you may as well.
No, exactly. So let's go through Harvard Grace's process in order to make a deal successful.
Yeah. Well, it can start months and months before the actual closing. And matter of fact, this afternoon, I'm writing an LOI on a piece of property. Again, I have offered 3 different LOIs on this same property for the last 3 years. And I just, until you buy them, you just keep following them. And so it can take months. It can just take a very short period of time if the seller's ready. And so you find the property, and if you get to an accepted LOI, and then you get to a contract, you just then you start your due diligence phase.
Yeah. Talk about that. What is in your due diligence phase that is a major, like we want to talk, sometimes we talk about alphas and edges. Do you have an alpha or an edge in your due diligence phase?
Not completely sure what alphas and edges mean, but
sorry, like, do you have a differentiation that separates you from a different company?
I honestly don't know. The most important thing to us is the leases,
right?
And as we have made mistakes over the years, we put the leases out basically to a committee, and we've just added an AI source to analyze these leases for us. And darned if it didn't teach us something right from the get-go. Oh gosh, we hadn't seen that, on a deal that we're working on. And it will, you feed it in all the leases, and it will put together a lease synopsis. Now, that doesn't give you the right to not read them yourself, because AI is not perfect, but it can certainly shorten the workloads. But the leases are what we are buying. And other than that, it's the physical plant, if you would, the current state of the physical property. So we will hire a team of experts to look at that. There's a general inspector, and then we'll have specialists that we know to look at the HVAC and the elevators, if there happens to be an elevator.
Big one. Some people miss those. Some people miss those ones. I'm a developer, so elevators they move the building. They move the needle. That's for sure.
And they're the bane of my existence. We pay all these fees for people to be on call, and then something happens to the elevator and they don't show up for 3 days. But so those are the two main pieces. What's the financial side, and then what's the physical side? I leave the physical to other people on my team, and I read the summary reports, and then I'm focusing on what's the insurance. Insurance has gotten to be such a expensive item in the last few years, and we're actually moving to sort of group all of our properties together to share deductibles and share limits and things like that, where all of them can save some money, but insurance got
I mean, that's a way to lower your operating X, right? Like, when we talk about real estate, guys, the number one deal is, can you lower your OpEx? And if you can lower your OpEx, now all of a sudden your NOI goes up. And when I use these verbiages, operating expenditures and net operating income, if you can increase your net operating income on your exit, and I'm sorry, Stuart, I'm not sure if you guys are exiting or if you're just refinancing and holding, but when you see this, what is your cap rate exit that you're looking to achieve?
It depends on the asset class and the market. We have a large storage facility that we are actually expanding right now, and that's got the best cap rates that I'm seeing right now. People are always claiming their multifamilies are going for 4 3/4 and 5, and I'm just like, I'm not in that world. I'm not opposed. I think
the only time you're going to get somewhere that's a sub 5 cap rate if it's a brand new build and there's nothing left that you have to do, and it's fully stabilized and fully leased and to cap market rents. Like, you're not getting below 5.
Well, and if you are buying at 5 but you're financing at 6, you're in negative leverage, and that by definition means we're not going to cash flow day one, so it's sort of out of our box.
That's right.
I underwrite a lot of them. I think it's a great asset class, but but for our purposes, they're overpriced, and so people are buying those and holding them a few years, and then hopefully they start to cash flow at that time. So we expect our storage asset to sell Q4 of this year at a 6 1/4 cap.
Nice.
And that seems to be what the market is, 50 miles around where that one is.
What's your net operating income on that one?
Oh, you had to ask me. It's going to be That one stabilized will be 980,000.
Wow.
So,
Wow, that's a nice spread there.
That'll be a nice one. That'll be a nice one. So, and that one we're exiting. And storage is a great business. As I say,
we got a lot of stuff.
People got
a lot of stuff, right?
They do. Yeah.
And
then they put it in there and forget about it. So, average lifetime value of those guys is a little bit better than 3 years, and it's amazing.
Great asset class. Great asset class.
I don't like to manage it anymore. So when we will sell that one, the office and retail properties, we're more of the buy and hold kind of people. But we'll exit at the right time.
Nice. So you mentioned leverage, right?
Yeah.
And we mentioned leverage with the cap rates. How much leverage is too much in today's environment? Give me a number.
Yeah, my rule is 70% LTV is the top.
Okay. Right. Where, 3 to 5 years ago, it was 80, sometimes even 90%. People were loaning on that. And now there's a lot of projects underwater because of that. Right. So
in the last 2 years, I've had bankers try to convince me to go to 80 at the closings table. And I'm just like, been there, done that, lost the t-shirt, and 70s.
So takes me to my next question. What deal have you walked away from? Actually, sorry, I'm gonna reverse a little bit. So you went through some stuff in the 2008 crisis.
I did.
So I'm assuming when you went higher loan to value, that was during 2008. Yeah. And as you said, you lost the shirt.
100% then.
Right. So let's talk about that, because there are some similarities between then and what we're seeing now. I don't want to say it's drastic, but I think we've corrected a lot of different things in the banking system to avoid some of that. But our economy moving forward, the markets, and the unpredictability of the political landscape in the world right now creates a lot of pressure on different things. So talk about what you learned in 2008 going through that, and how it applies today, and how it helps you manage Harvard Grace to be an excellent investment fund and a place for people to park their money.
Well, my entire investment thesis is basically framed on what I learned during 2008, 2009, and even 2007, signals that I ignored that smarter people did not. And I can sum it up as this: you don't know what you don't know.
Love it. I love that phrase.
And I was buying residential rentals at that time, and most of them were full. And I had a management company, and we were positioned, but I was doing what they call, I guess, the equity ladder or whatever. I'd buy this one, wait 18 months, get it reappraised, pull cash out, buy something else, and do this and do. And so I had very little cash into any of these properties, and most of them were blue collar type properties, and
asset rich and cash poor, right?
Yeah, totally. At June 30th, 2008, my net worth was in excess of $20 million by appraisal. Fudge, no fuzz. 90 days later, I figured I was $5 million underwater.
I'm sorry, I don't mean to laugh, because
it is fun. But
listen, I'm up in Canada, and we're facing similar things right now. Right. There's a lot of we're just a whole different mess up here than what's going on down in the U.S. right now. But it doesn't change the fact that there's signs on both, and obviously you've grown from those mistakes. I don't even want to say they're mistakes, because again, you don't know what you don't know, and it didn't sound like you did anything wrong, but the market just flipped upside down. Yeah. Right.
Well, it wasn't wrong when the banks were lending me the money.
Exactly.
6 months later, they're, it seemed like wrong, and I'm an evil person. Yeah. But they were mistakes. Okay. I mean, whenever your plan is based upon everything going exactly right, that's not a good plan. Not only have I put a limit on our leverage, we also build at least 12 months worth of reserves of cash into every deal, which is a bit extreme, and it does lower our returns because it's cash that's sitting there not generating anything, but
it's safe.
but it's safe, and people like that. And is that crazy for a multi-tenant building? Maybe a little, but I mean, crazy like a fox, maybe. But
So we call that in the business, we call that a contingency.
yeah,
right? We call that a contingency, and I think it's very admirable and ethical that you have that, and that's probably one of the things that's going to separate Harvard Grace, parking your money there versus parking your money somewhere else who doesn't have that. So if you're listening to this, guys, and you're an LP and you're a potential investor, you got to understand that Stuart Heath and his team have built in a contingency plan to keep your capital safe, and I don't think there's anything wrong with that. If it's going to lower your return by 1 or 2%, and you are given security to potential investors, to me, that's better than that 2%.
I agree. And we've parted ways with people who didn't agree with that strategy, and that's okay.
Mm-hmm.
That's okay. We're going to do this the boring way, if you don't. So,
your tagline is "Boring is beautiful." So let's keep it like that. And if you are producing ethical returns, and I say ethical returns because I think that that's a huge thing in today's world, that you know where the money's coming from, you know where the money's going. So that's going to kind of segue us into something I want to talk about, your capital allocation. So let's elevate this to capital allocation and how Harvard Grace allocates its capital. We've obviously talked about your buy box. We've talked about your process. So when you look at your corridor, I-95 corridor, which I've driven down many times going south, because escaping winters up here, we get in our car and we drive south. We don't stop until we hit water, right? So talk to us about how you guys distribute your allocation, whether it's self-storage or whether it's an office building, or a multifamily tenanted building. Talk to us about that.
Yeah. So currently, our capital is allocated about 40% into medical offices.
Fantastic class.
30% suburban office, and there's always a little crossover between those two, and then 20% storage.
Okay.
And we looked at going into storage. I get very afraid because storage is either a home run or they languish at about 70% occupancy and stuff like that. And so I get very afraid of stuff like that, especially when they can move out on you. But the big allocation, it's a niche play. They're all giant units, and it's almost small warehouse versus storage. Medical office. I mean, sort of accidental brilliance backed into this one. We bought one, our third deal, and start looking at this, and these tenants have hundreds of thousands of dollars invested, their own money invested in their spaces. They generally want 10-year leases, if not longer, and which actually puts the onus back on us. You better write that lease right.
Yes.
But then they're there. Then they're there. I mean, I just renewed a 20-year lease at one of our properties, and we arm wrestle a little bit over rates and annual increases. But the other side of it, they don't negotiate that hard.
No.
And I think that speaks more to the margins in that business than it does, business acumen or anything like that. But it's just, you're dealing with business people, and you just got really long-term tenants, and the financials are right. And they're not tempted to go anywhere. I love the suburban office, and we were buying that in 21.
Explain what a suburban office would be, right?
So it's an office building in a non-business district. It's not downtown, and it's not in some sort of big corporate center that are sprinkled around the big cities.
Right. They're not in a business park. They're they're kind of standalone buildings.
They're not Class A buildings. I can put it that way.
Okay.
So because those type of buildings, especially downtown and the Class A buildings, those are places where businesses collect their employees. It is not a place where they meet their customers.
Right.
And so what we sort of discovered early on is that And of course, all of this is coming through COVID. COVID colors everything.
Yep.
And we in the South pretended like there was no pandemic from about June of 2020 on, and nobody was staying home. But all of these, all of these places where people see their customers, they were full.
Yeah.
I had vacancies going into COVID, and I thought, well, we'll wait a couple of years. I leased them up during COVID, and that's because these were businesses who'd had to meet their customers, so they're customer-facing tenants. And so a lot of people may call that service retail, and that's a good word for it too. But service retail can also be restaurants, and we generally don't go that far. We like some retail as well. I don't have anything with a restaurant.
Smart.
And they're just not as stable as other type tenants.
So I love that. I love the fact that when you're looking for stability in your tenants. I mean, we talk about medical. Though the medical grade tenants there's no better tenant when it comes to commercial real estate than that, right? Yeah. So that's good. That's good. So
your insurance agencies, your mortgage companies, dentists who are medical, but they don't necessarily go to medical buildings.
That's right.
And just any type of thing. A lot of ministries will pick up space, and a lot of them are very well funded. So
that's great. Good.
Yeah.
So if I'm deploying 15 million across private markets right now, why should real estate, and predominantly commercial real estate, earn my allocation versus the private credit or private debt or whatever it may be?
Well, first and foremost, the tax advantages.
Okay.
So there's not any real tax advantages of private debt or anything like that any more than there is buying a bond.
Yeah.
Or getting dividends from. So,
can you unpack that a little bit more? Like, can you explain how that works to advantage for an LP investor? Because we know that when we own, real estate, that there's a major tax advantage. From a singular perspective, me as an owner, but me as an investor, break it down on how that can help my portfolio and help me as an individual.
Yeah. First and foremost, and there are multiple levels to tax advantages for real estate. First and foremost is the bonus depreciation. It's been around since 2018. It just got re-upped again last year for 100% bonus depreciation in the one big beautiful bill, and it's real. So what that applies to is not actually the real estate, but the personal property.
Right.
For years, commercial real estate property investors have done what's called a cost segregation study, where they have an engineering-based study, and they pull out the personal property that's a part of every piece of real property, whether it's light fixtures, carpet tiles, that can be picked up and used somewhere else, and there's just a whole IRS rule of how you can calculate what that's worth. Your typical office building, you're going to allocate about 30% of your purchase price will go to personal property. A self-storage building, I'm not kidding, will go almost 85%.
Wow.
And multifamily should be around the 45 to 55% range. So just say you buy a $10 million building, it's an office building, 3 million of that's getting reclassified as personal property and a charge off that you can do year one.
Wow.
Okay. So $3 million, which is remarkably close to the equity component.
Interesting.
Yeah, and so you can potentially offer your investor 100% write-off in year one. Now that does not mean they get to use all of that, but
right.
What they will get to do is that, depending on their own situation, they can use it all in year one, but at the very least, that's going to shelter the income, and our deals always throw off income. It's going to shelter that income for at least 3 or 4 years.
That's awesome.
So you're going to start out with a 5 or 6% return. That's going to jump to 10 within about 2 years.
Yeah.
In 11 and 12, tax-free. Tax-free.
So like that.
And you will run out of depreciation one day. But you'll always be depreciating the rest of the building, so there's still some shelter left. The second tax component that benefits commercial real estate is, even though it's like a business, it gets capital gain treatment. And, when you do sell it, which is the 20% flat rate, which is great. And then one of my favorites, and I mentioned this earlier, is kind of like your home. You can refinance, pull cash out, get a HELOC, do what, we can refinance that building. And generally, based on market conditions, we'll do that every 3 to 4 years. Pull cash out, we send it to our investors, and that's tax-free. Now, we hope they take that cash and do another deal with this. Yeah.
Right? You can't get taxed on borrowed money.
You can't.
No.
And so you won't ever have any real tax from that until you actually sell the property. And I know people who've been doing this for 50 years on the same property, and it's there's no other asset class like that. The only thing that really comes close is oil and gas, and that's a great asset class too.
Yeah, there's some great tax advantages in oil and gas as well.
It's a little bit more volatile than real estate.
Totally.
But we gotta have it.
It's we're built, our whole society and economy is built off the backs of petroleum. So I don't think it's going anywhere anytime soon, but that's a whole other podcast that we can We're sticking with the real estate stuff right now. So right now we're kind of in a rate cycle, right? There's some office demand shifts. You're seeing people going back to work. So some of these buildings are starting to fill back up again because people who were on 10, 20-year leases, they couldn't get out of them, and they were just, overhead was going through. We might as well bring our group back to work, all these different things. Self-storage, seems to be quite resilient through these times. But, where do you see the best asymmetrical opportunity right now?
Best asymmetrical opportunity. It's probably still in office. And office is a heavily regionalized thing. It's a very different market in the South than it is in Chicago or Texas, or LA or New York. And the big city centers of the South, Atlanta, Nashville, Birmingham, their downtown areas did see a fall off, but that has largely reversed itself. Still, there's a lot of people who think that office is risky. It's as risky as any 85% occupied property can be, and so
people are scared.
They are scared
of a pandemic, right?
And let's face it. I hope that's the only time we ever see that in our life. I would have never predicted that the government would have told everybody to stay home and people would have obeyed. And 10% of the people didn't, and I didn't. Somebody had to go get the mail and get the rent checks.
That's right.
And what was very clear, at least around here, is nobody was going to work, but nobody was staying home. So, when you got into the middle of a traffic jam in May of 2025 in the middle of the day, people aren't staying home. So anyway, but still office is it, because we're buying at 8.75 and 9 cap buildings. What I'm convinced will be 7 caps in 3 years.
Yeah. So it's interesting. It's very interesting that you say that, right? So you're purchasing at a high cap, and you restabilize them, you bring them up to market rent or whatever, however you do it, little facelift, lipstick on a pig, however you want to do it, you increase the rents. No different than a multifamily, building where you try to get rid of tenants that are not great tenants or vacancies that are run down, you fix them up, you rent them for a higher price. So you're looking at buying these buildings for essentially pennies on the dollar from what they went 5-6 years ago, maybe even 10 years ago,
right?
Because leases have vacated during COVID, and now you're buying them at a 9-10 cap, and you're going to do some slow things and turn around and refinance them at a 7 cap.
Yep.
That to me is not boring and but beautiful. But I'm a little bit crazy. I'm a little bit different, a little bit weird when it comes to those things. So tell me and everybody listening to you what that does for an LP investor in Harvard Grace.
Well, it's the in and the exit cap rates are the biggest places for your value movements. What you buy it for and what you exit for. I mean, that makes sense to almost everybody. But if you're doing it at a different multiple, it's a bit of financial arbitrage, if you want to use that word. Buying in one market and selling at another, where the valuations are different. So the difference between buying at a 9 cap and selling at a 7, on a $10 million property can be worth $2 million.
There you go.
And all of that falls to the equity class. And
remember, when you refinance that at a 7 cap, you're not paying taxes on that refinance.
You're not.
Refinance dollars.
Yeah, and to us, that's our value add.
Okay.
We don't do big renovations. We don't do development. I don't even do floating rate debt. And so I control all risks except vacancy risk. But because we come in with professional management, I can have as much of an impact as putting in new countertops.
Yeah.
Just by writing my leases at market rates with good cost controls in them. So,
being vertically integrated is a huge plus for you guys, on the property management side of things. Absolutely. Gives you control. Like you said, you want to control all the risk except for vacancies, which if you have a good marketing team, you also control.
Yeah. Well, I mean, you can't do anything about some tenant that outgrew you or goes out of business. And so, we keep our properties looking nice and keep them happy so that they want to stay.
Yeah.
But at the end of the day, you're always going to end up with some vacancy, and there's not a whole lot that you can do about it.
So let's shift this a little bit here, because this is a topic that I think is on everybody's mind, right? AI. Okay. So how do you guys integrate AI into your daily business, and where do you see AI in the real estate world in the next 5 to 10 years?
I hate this question, but
I know, but we got to ask it because everybody.
Sure, no, it's a good question, but you're sort of asking me to be a prophet, and I have been very slow to adopt AI because, in my experience, and we test it, I use it every day. I find it to be about a C student, most of the times. Now, just 2 weeks ago, I finally gotten excited about it. Where I was introduced to a new tool, and I was shown what kind of productivity it could have, and that's when we started feeding it leases to analyze and create a lease synopsis for us, which is awesome. And just playing around with it, I fed it a deal that we already did. I took an offering memorandum that's prepared by the seller that was very good and detailed, just really one PDF document. Said, write me a letter of intent and suggest the purchase price that we should. And I mean, and it wrote me a nice letter of intent. It had one typo, so but it came within $20,000 of the price we actually negotiated and paid.
Oh wow, that's pretty good.
And then I asked it, what was your pricing analysis? How'd you arrive at that? It gave me 4 points, and so I couldn't have said it better myself. Yeah. I was like, wow, maybe I've been replaced. So,
here's the thing about that, and this is what I'll say, is in real estate, from what I've seen and the direction that I think that AI is going, it's not going to replace anybody's job, but what it will do is it will replace people who don't use it.
Oh yeah, I agree.
Right? So if you're not adopting it, you're just gonna be too slow to adapt to anything. Like you said, you could feed in. You look at an office building and there's 100 leases there. You could feed all those 100 leases in and say, give me a lease synopsis. Which ones are good? Which ones are bad?
Yeah, exactly. So we have been using it for over a year to help us create content for our social media and our email campaign, and it does learn, and and it adopts my smart aleck sense of humor, and that's been helpful. It's made that process faster. But I've just really gotten excited about the whole analysis piece.
It's great.
Where it's going from here, I don't know. I don't like the idea of AI doing investor relations work. There's no doubt that it could do that.
Yeah.
But our investors are near and dear to us, and we like to have a personal relationship with them. But then again, there's maybe some investors who would prefer to just deal with a computer, and so we will have that option as that comes along.
Love it.
But that's not gonna, it's not gonna stop me from calling Bob Smith and say, hey, let's catch up and just talk through stuff. So, we're already using it. We were already using it through some of our property management tools. So it'll be helpful for tenants, and hopefully it'll call the right plumber before we check the voicemail and get it. So I can see that kind of. So hopefully that speeds things up so that the plumber can send his out there to unclog the toilet. So
there you go. And I think I'm a bit of I'm a movie guy sometimes, so I feel like we're heading down to Skynet pretty quickly here, or the Matrix. I don't know whatever's going on, whatever those worlds are bridged.
I'm a robot fan myself. So
that's right. That's a very good. I feel like that's one of the more applicable ones, especially with Elon and his robots coming out. But I think we're at a precipice of we're at a change in the way that we operate as individuals. And I think at the when the .com came, my biggest revelation or remembrance was Y2K, right? And how that was going to end the world because the computers couldn't calculate the date properly, moving from 99 to 2000, right? So that was my biggest thing that I'm 45, so that was kind of where I was. I missed the .com transition on how it revolutionized everything. I just remembered at one point the phone book just stopped coming. There was no more phone book, right? And I think that was it. Like that was like, hey, no more phone book. We don't need them. Waste of money. Get rid of them, right? So I feel like if you don't adopt it and don't learn it in some way, shape, or form, that your business is going to struggle in the next 5 to 10 years.
I think human labor will just continue to go up in price, and then at some point you won't be able to afford to do mundane things.
I agree. So what is your number one rule at Harvard Grace for protecting investor capital?
I don't know that we have a stated rule for that other than just don't deviate from the buy box.
Beautiful.
And we're human. I get excited about deals, and that's why I keep a group around me, and we're just like, okay, this is one we shouldn't do. I got really excited 2 years ago about a brand new storage facility not far from where I live, and it was beautiful, but it was being completely mismanaged, and it just was not going to cash flow from day one.
Right.
And so we stopped, and they're still for sale today. And it's a management issue, and we've offered the management contracts. I don't usually do that. I can go in there and fix it, then I'll buy it from you.
Yeah. Well, fix it on your dime, and then I'll purchase it at the price that you want. It's actually, in my world, in land and real estate and development, we call that an agreement of sale. Hey, you hold this property for another 6 to 8 months. Let me rezone it. Let me re-entitle it, and then we'll purchase it at price where we're a year closer to shovel ready than we were. Or I have a network of developers that it's like, hey guys, I got this one that's ready to go, and there's no money out of my pocket. I essentially wholesale it for value lift, right?
Yeah. So if I had to state that as a rule, I would say stick to the investment thesis.
I love it. So where's Harvard Grace Capital headed in the next 5 years?
Well, we have just launched and are currently raising for our first fund. Everything we've done to date have been single asset syndications.
Yeah.
But we've engaged bankers and we've got our whole team involved. Going to be a $20 million fund.
Awesome.
And so that's $20 million of equity, which will be somewhere between 50 and $60 million worth of acquisitions. I would expect in the next 12 months. And I hope to be here with you next year talking about fund number 2.
I love it.
And it's going to be the same thing, more boring, hopefully a little bit bigger price point than we've been able to pursue. Usually we'll do a raise between $2 and $3.5 million. So this will allow us to buy some bigger assets, and they're out there. My desk is full of deals we want to pursue right now. And so, and that's to go a little faster and to buy a little bigger, because kind of what we were talking about before is cap rates are going to right size. And so there's an opportunity to get out here. I think it's a generational opportunity. You're going to buy some great assets at some great prices and exit around 2031, 2032 at some generational capital gains. And
I love it.
And I think that's where we're headed. So.
Great. I mean, I think that's a fantastic goal. I mean, essentially you did your proof of concept with, your multiple syndications, right? Now it's, hey, let's put this all under one umbrella, one roof, get after it, give our investors the best foot forward, do a fund one. We're going to, do a smaller fund, get it moving, get it going. And then next year we're going to potentially launch fund 2 at 50, 60 to $100 million. Love it. I think that's a fantastic opportunity. It sounds like that you guys you've positioned yourself very well in your market, and you're kind of experts in that field, in that corridor. I love it. I love the fact that you don't deviate from that corridor. I think too many people look at, I'm gonna do a deal in Texas, and then I'm gonna do a deal in Florida. Oh, you know what? This multifamily building in Detroit I can get it for $50,000 a door. So let's do that. And all of a sudden, your operation is nationwide, and you're spread super thin because you have a property management company there, property management company here, But I love the fact that you know what you do, what you do well, you do it. You stick inside your buy box, which I think is absolutely imperative for the success of a real estate fund, is to never deviate from your buy box. So when you said that's your number one rule, got me excited, because I'm sitting here thinking that Stuart Heath and his team at Harvard Grace Capital are a place that if I had some excess capital right now, I'd park my money there.
Well, thank you. I appreciate it.
So if you could give one piece of advice to someone who's deploying serious capital this year, what would it be? And you can't say buy box now, because we just went over that. So let's reframe that question. So if you could give one piece of advice for an LP, potential limited partner, who's coming into or looking to deploy their capital, their fund, their money, park it somewhere, what would that advice be for them?
Investigate the sponsor of the deals heavily. Whereas LP, you're not responsible for operating the deal. You are responsible for doing due diligence on the sponsor. And we encourage people. We've actually put together a doc of 100 questions to ask your passive activity sponsor. And it's exhaustive. And I have to say, our people don't do that to us. And most LPs tend to invest on emotion, and like and trust a person, and that's worked out okay for our LPs, but it doesn't work out for every LP. But you do your homework and check us out. Check out anybody that you're talking to, and if there's any resistance there, go next door. Go to the next guy, because there shouldn't be. They should welcome your questions, because that makes you a serious investor.
I love that. Make sure that your LPs do DD on you. And I think or on whoever they're going to invest with. So,
That's right.
It's something that we talk about all the time in our fund management groups, that, here's a due diligence questionnaire that you should have the answers to, and that they can. So here's a potential LP questionnaire. You got to be able to answer these confidently and portray the direction that you're taking your fund, so that you can have them trust you that you're not going to lose their money. And at the end of the day, that is the biggest thing, is that don't lose somebody money.
That's right.
Well, Stuart, I want to thank you for jumping on here today on FundFocus. Great catching up, great talking to you, and I'm really excited to see where you're going. And hopefully we can have you on again next year when we talk about Fund 2 and the successes of Fund 1. So thank you for that. And, God bless and keep moving forward.
Yes, sir. Thank you.